Welcome back, ladies and gentlemen. I'd like to begin by saying hindsight is notably cleverer than foresight. What do you think? And hence, foresight is not necessarily really about predicting the future. It's about knowing the future so that one is able to minimize the surprises. On that note, we have our next panel discussion on the theme Crystal Gazing Next 5 Years of Growth in Business Earnings in Various Sectors and Industries. The eminent panelists for this session are Mr. Anshul Saigal, Mr. Madan Gopal Ramu, and Mr. Shailendra Kumar, and our moderator is Ms. Rakhi Prasad. Now, let me take a moment to introduce them to you. Mr. Anshul Saigal heads the Portfolio Management Services business at Kotak AMC. He is an expert on value investing principles, preserving capital, and generating market-beating returns. And Anshul has over 20 years of experience in the Indian capital market. He spent close to 14 years of those years with Kotak Portfolio Management Services. And prior to this, he has worked with JP Morgan Equity Research, ICICI Bank, and Standard Chartered Bank, where he analyzed equities and corporate credit. Now, Mr. Sehgal completed his MBA in finance from Management Development Institute, Gurgaon, and received his engineering degree in industrial engineering from SIT. We have with us Mr. Madan Gopal Ramu, who's the fund manager for PMS and Alternative Investment Funds Category 3 with around 14 years of experience in the Indian financial markets. And he currently manages an AUM of rupees 1,835 crores and has over 4 years of experience in managing funds. He joined Sundaram Mutual Fund in 2010 as a research analyst from Centrum Broking and has made rapid progress during his tenure in Sundaram AMC. He became head of research in April 2015 and started actively managing funds from January 2016. He comes with strong academic qualifications and he's a qualified cost accountant and has a management degree from BIM Trichy. We have with us Mr. Shailendra Kumar, the co-founder and CIO of Narnolia. Under his leadership, Narnolia has received numerous awards, including the most consistent portfolio manager and is considered a premium investment advisory firm. He is known for his deep understanding of investment theories, stock selection, and portfolio allocation. He has successfully developed and implemented all 4 major investing and trading strategies, namely value, growth, reversion, and momentum. His preferred investing style is growth and value. He has done extensive work on corporate valuation and derivative pricing, and he has written as well as guided, in fact, several finance research papers. Now, he holds a postgraduate degree from IIT Delhi. Ladies and gentlemen, this session will be moderated by Ms. Rakhi Prasad, who is an investment manager at Alder Capital, with a focus on investment research covering financials, healthcare, and technology. She has over 20 years of experience across asset management, investment, banking, private equity, and risk management. She started her career at Goldman Sachs, New York, and she holds a master's degree in financial engineering from Columbia University and bachelor degrees from University of Michigan and Lady Shri Ram College. She is the founding member of the Women's Investment Network and a member of the Bloomberg Women's Buy-Side Network, and is also a board member of the recently listed technology company MapMy India. She has been honored as India's top 100 women in finance in 2020 by AIWMI. With that, a very warm welcome to our panelists, Mr. Anshul Saigal, Mr. Madan Gopal Ramu, and Mr. Shailendra Kumar. It's now over to our moderator, Ms. Rakhi Prasad. Over to you, ma'am.
Thank you, Aishwarya. Good morning, all. So we have about 40 minutes to deep dive into the future. I think we are lucky to, look at the future and not think about the immediate short-term volatility that's going on in the markets these days. So, but it's always important for investors to sometimes zoom out once in a while and see, are we on track on achieving our long-term goals? It's difficult to do this sometimes in this age of instant gratification and short messaging, but we'll try with our esteemed panelists to look forward to an insightful conversation with them who will give us direction over the next 5 years. So with that, let's crystal gaze, Anshul, Madan, and Shailendra, over the next 5 years of growth in business earnings in various sectors and industries. So I'm just going to start this conversation with your first thoughts. Let's just get right to the crux of the matter. So I'll just ask each one of you around the table to give what are your thoughts over the overarching themes that will play out over the next 5 years. Madan, would you like to start this?
Sure. Um, Good morning, everyone. And as an house, we pay a lot of attention on earnings. And I think in this market, earnings is going to be very, very important as we pass through this volatile period. And we don't take a short-term view on earnings. Generally, we pick companies who can deliver earnings growth over a longer period of time. Say, generally, we look for companies who can, grow in, say, 20% sort of rate for next 5 years or so. So when we do that kind of an analysis and filter out companies, we look out for managements who can clearly lay out their capex plans for the next, say, 5 years or so. And today in India, that kind of an opportunity is increasing. We can see that happening in consumer-facing companies. We can see that happening in manufacturing companies. In manufacturing, particularly, if you see, a lot of these chemicals and drug companies have created some capabilities which are enabling them to get more orders, which we are seeing it with various companies like Navin Fluorine and Gland Pharma sort of companies. They have a very clear capex plan over the next 5 years, good amount of new projects coming through. This is probably a China plus one story, you can say, or it can be a pure ability to win orders globally, being competitive. That space in manufacturing, India seems to be getting some advantage at this point, which was not so clear in a pre-COVID period. So in post-COVID, these themes are getting much more structural and much more concrete. And if you bet on some of these companies who can establish a clear capex plan over the next 5 years, invest into them, as they execute these plans, you will see earnings coming through. And despite the volatility over the next, say, one year or so, if you can get these companies at a real good valuation also, then I think the earnings, you can really go through that phase of making good returns over the next 4 or 5 years. Another trait we see at this point in the market is there are companies, established companies with very good unit economics in their existing business. They are investing back a lot of money into the digital capabilities. For example, an ICICI Bank. ICICI Bank's spending almost 8% of their cost, which is 4% of the income, and almost closer to roughly 40 basis points they are planning to invest, which is not something any bank can do it. Because there are many banks who are not even able to do a 1% sort of an ROA. So when these kind of companies, which are leaders in their respective space, who have higher profitability, very high ROIC, they are investing back into the digital capabilities and building their capabilities. We feel that they can gain more market share out of weaker peers. And they can also defend their growth, not just defend their existing market share, but also defend their growth, say, compared to the fintechs or, say, other digital companies or e-commerce companies coming into the space. This is not just in financial space. We are seeing this happening in even consumer space. So these are two traits we are looking for in any management at this point of time, when we look for, say, whether we can invest into them from a 5-year perspective and avoid all the noises which will be there for the next, say, 6-7 months, and look for whether we can get any of these ideas at a real good valuation. So these are the two traits we are looking at. Other than that, we have some sectors which are looking really good, but I think these are very important. From as you said, crystal gazing over next 5 years, these themes seems to be emerging very clearly out for us.
Yeah, that's great. Shailendra, why don't you add to that?
So, I'll give you a little broader perspective here, the way I am looking at, see, 2022 is a great inflection year to my mind. And the next 5 year, whatever is going to happen, the large part of those components will come from 2022 to my mind, we were living in a kind of a regime for almost more than 10 plus years globally, For most of the major economy, there was monetary easing happening on a continuous basis. You take Bank of Japan, you take Europe, you take US. So we lived in a era of last 10 plus years where the monetary easing was happening in a continuous manner, right? And you had all kind of a support. So if the financial asset prices goes down by a little bit, you knew that the US Fed is going to come and support you, right? And 2022 is important in that sense that now things are changing for sure, right? We are now going into a more calibrated monetary zone, not an easy liquidity policy. And this will have a very larger ramification on every asset class across the world. I mean, you take currency, you take fixed income, you take commodity, you take equity, all asset classes will have the impact here on, To come to Indian equity, what I am reading right now in that larger perspective sense is that for last 10 years almost, majority of us investors, I mean, we were buying quality company, right? And we were making money. We were beating the benchmark. Or we were buying some very fast growing company and we were beating the benchmark, right? But somewhere, when you look at the thing fundamentally, there are three distinctly key attributes to a company stock prices, right? Or the company per se in a fundamental sense. You got quality for sure, you got growth, and you have a valuation access also. And these three are uniquely distinct, right? So for the last 10 years, because of this easy monetary regime, what you had was you pick one axis or one of the variable, be good at that, and you will beat the market, right? But now in this normalized kind of a liquidity zone, one adjustment that we all investors has to make, that we can't ignore now any of the axes. So we have to keep buying quality company, good capital allocator in that sense, right? We have to buy a company which has a foreseeable 3-4 year good amount of growth in their numbers. But at the same time, we have to be very, very conscious of on the valuation axis, how much price I'm paying right now, right? So now what the major change for the next 5 years that I foresee is like, we have to get our investment thesis little bit more tuned and more balanced on the three axes together. So that's one thing that we are very, very conscious of right now.
Well, fair point. I mean, we all have to be conscious of where we're putting our money in over the next 5 years. Anshul, please step in and give your expertise since you have seen the markets for 20 years. I'm sure 5 years is not such a long term in that sense.
Thanks, Rakhi. Good morning, everyone. Thanks for having me over. I'd like to look at the next 5 years from the perspective of what's happening domestically and what's happening in the context of the country internationally. Now, if you look at India and the current per capita GDP, we're at about $2,000 odd. And roughly 30% of this amount comes into consumption in the country from households, that is. So, a rough back of the envelope kind of calculation tells you about $500 to $600. That's what is coming into the economy for consumption. Now, let's look 5 years out. If what the government is talking of, that the country will be say a 5 trillion GDP country, and everything else remains equal, we see our per capita GDP going to $3,500 odd. And assuming that the savings as also essentials, those remain at where they are today, or maybe just mildly go up, the amount that we'll have for consumption will be 3 times the amount that we have today, which is roughly in the range of $1,500 to $1,600. And that amount is what will come into the economy to spur sector after sector. And this is on the consumption side. Now let's look at the overseas impact of what is going to happen to India. We have roughly $0.6 trillion of our $2.5 to $3 trillion economy coming from exports. Now, add to this just the PLI scheme today. We believe that roughly $0.2 trillion can be added to this just from PLI. And then, of course, there will be natural organic growth in exports. And so, anywhere from 1 to 1.5 trillion is what one can anticipate coming from exports over the next 5 years. Now, these two vantage points or engines, if we add to the Indian economy today, it looks like there will be sector after sector which will be a beneficiary. It is left to fund managers and investors like us to identify what is the right opportunity to play in this theme. And in our judgment, to some extent, things have been made simple, not easy, but simple. what we are seeing as a trend over the last 10 years is that large is becoming larger for all the reasons my colleagues just spoke about today. Scale is becoming a huge competitive advantage. And for that reason, if you get the sector right, if you get the segment right, and your time horizon is not the next 3 months or 6 months, and you're investing for the next 4 or 5 years, irrespective of volatility, being able to identify the leaders in respective sectors is in itself a simple option for many investors to follow. And so in our judgment, top down, India is an opportunity which is at a cusp and is going to play out like it has never played out in the past. And in many ways, investing has been made simple. Look for quality, look for leaders, and look for them when they are available at reasonable valuation. As long as you can do that, you're home.
I guess we're seeing a certain trend amongst our panelists about quality is still key. Earnings momentum growth is also very key to continue on, and it's a matter of which sectors that one should look at from an investor's point of view to deep dive to take advantage of India's growth over the next 4 or 5 years. So from that perspective, I just wanted to zoom up a little bit more, look at the macro. What do you think would be India's, so go 5 years out and tell us what do you feel India will be at in terms of rupee export contribution? I know Anshul mentioned, gave us some metrics around where he thinks consumption might be, but give our audience and attendees some sense about where India will be 5 years from now. Shailendra, would you like to start with that?
To look at the next 5 years, you have to understand, how the last 5-10 years has been, See, our economy was slowing down. You look at the parameter after the parameter, you look at bank credit growth, you look at export growth, you look at electricity demand for that matter, We were slowing down since 2010-11 itself. If you look at all these major macro parameters, looking at the India's economic construct. 2015, a large cleanup started, a lot of structural reform started. And those cleanup were necessary for sure, right? We will all agree. But the thing is that large cleanup surely means a further slowdown in a current set of economic activity. So when the pandemic hit us, 2020, January, February, March, before the pandemic hit us, even then we were slowing down, right? But today, when you look at all the macro in terms of all the parameters, what we are seeing a very, very different pictures. Things have completely changed. And we are surely set for a multiple year of strong growth, right? Among the major economy, we surely will be continuously the highest or the fastest growing economy, right? And you can talk of all the regions, all the structural reform which has happened on the NPA cleanup side, the IBC, all the GST and RERA and etc., etc. Also, we have seen already the success in electronic manufacturing because of PLI for sure. For the last 4 or 5 years, this is one sector which has grown by 24% CAGR, right? And now post the COVID, this China plus one story will surely give you some more kick in, right? That's very, very guaranteed. Defense production is another layer which will add to the whole buoyancy. PLI in other sectors like, all this textile, the food processing, the auto component. One important thing which is changing now, which will impact the next 5 years. This budget and the last budget was basically a policy by the government to increase the government capex. Last year also we had a 30% growth in government capex. This year again, we are seeing the same numbers. Why? Because private capex was not happening till now. But now as things are stacked up, by the end of this financial year itself, we will see a private capex. And private capex is a virtuous cycle. Like we all know, government capex can be fickle, but the private capex, once it starts, at least 7-8 years of run room you get for that thing going, right? So those will be what will be shaping 12-13% kind of a nominal GDP for the next 5 years looks very certain, and then you can calculate the number what it comes to be. Private consumption, as you said, I think it will remain a laggard for some time, and we are fixed into $1,800-1,900 kind of a dollar per capita income. I think in the next 2 years, as Anshul also said, when we hit say like 2,500 kind of a number, the next kind of consumption zone will start. You have to switch from where you are today to go to $2,500 at least. And then the next round of premiumization among the consumption basket will happen, which will increase that side also. So this is how things look stacked right now.
Great. Actually, that points me back to Madan, because he was the one who spoke about capex, and so Shailendra seems to be very bullish. Are we back to the 2003 to 2009 capex cycle, which India enjoyed and which resulted in growth across all sectors? If you could give us some insights around that.
See, this this capex cycle is going to be definitely very different from the previous capex cycle. At that point of time, India was deficit across all infrastructure sectors. You take power, you take road, you take railways, everything was under deficit. The port also was under deficit. So, but that was driven by more global capex, and China was literally taking up a large amount of its middle class up. So that was driven by more of a China capex, which drove the entire global capex. India also participated in it, and we had a very nice setup for that. But this time the capex is going to be driven, the speed at which it can accelerate may not be at the speed at which it happened in 2003, 2008. This is going to be much more slower and steady, probably. But yes, as Mr. Shailendra was pointing out, in the pre-COVID period, manufacturing was literally struggling in India. You had continuously certain reforms which were being taken from a long-term perspective were hitting us every year. And despite being a developing country, we were seeing flattish manufacturing growth for 2 years, in my opinion. So from that perspective, getting into a scenario where both the services as well as manufacturing can grow better than the pre-COVID level. So the momentum is set, no issues about it. How we execute it is very important. I think inflation will play a major role on how stable this growth can sustain from a long-term perspective. There are certain articles which are showing very clearly India is up there from a manufacturing competitiveness point of view. There are only 2 areas we are lagging behind compared to other, say, competing nations like Vietnam or say Mexico, or to really get a major share out of these export stories. There are only 2 areas where India is lagging behind still, just taxes and the interest rates. Taxes, some reforms have already taken place. We will see how they pan out, and we should see the positive things coming out. But interest rate, at these interest rates, it will be really difficult for us to compete. Current interest rates are lower for reasons we know because of COVID and all. It is going to go up now, but where we stop? Are we going to go back to 7? The yields are going to go back to 7.5%, 8%. Are going to stay around 7%. It's going to be a real critical thing. We can't let the interest rates, domestic inflation, go out of hand and lose our competitiveness. So these are the things which will be in front of us. But opportunity is definitely there, and India has to maintain its competitiveness and ensure that take the benefit out of the IT sector growth right now, the services sector growth happening right now, and put the money in the right place. If you ask me in the budget, I would say I'm a little disappointed because the PLI scheme at the rate at which it is happening, it's not something which is going to push the manufacturing to a greater level. We need much more support, much concrete sort of actions. Yes, there are certain incentives which are definitely good to know, but I've also seen certain sectors losing out of incentive at this point when everything was looking up and everything was looking good to take the India's manufacturing story to the next level. So these are certain things which I always feel that manufacturing, if it comes back, the structural growth story in India is set. So a lot of positives are there to go ahead and look for it, but there are certain issues that if we can address, then as the other panelists are saying, this is a multi-year growth story, definitely. But definitely India is in a much better position compared to where it was in the pre-COVID period and compared to other emerging nations. So to that extent, I think from a rupee point of view, the kind of headaches we used to have in the past, those things probably can be handled much better in this cycle.
So I'll bring in Anshul on this. Madan, you really started the conversation on rupee. So Anshul, your perspective, do you think rupee will significantly depreciate, or because we are on a stronger footing this time round, we won't see that kind of depreciation happening? So 5 years out, where do you think the rupee or even inflation, right? We've seen that in periods of 4, 5, 6% inflation, the markets have done really well. But the moment inflation popped up around the 9, 10, 11%, we didn't see any kind of growth in the index. So any guidance or what would you want to pitch in on this?
Rakhi, we need to see India in the context of what's happening around the world. Let's look at the US. You have 7.5% inflation in the recent reading and 0% interest rates. Huge negative real rates. Look at, in the context of the real estate sector, look at what is happening in China. There is mayhem in the real estate sector over there. And in that context, look at India. How India has managed its fiscal in this really tough period. How it has managed the macro economy in a really tough period and has been able to seize opportunity in really tough times. While I agree with Madan that there are certain sectors which have actually been hurt because of, say, the PLI policies, or even I'd say tax policies in general. Let me give you an instance. The chemical sector has not the export benefits that were available to the chemical sector have been taken away, but those have been given in turn to the textile sector. So textile sector is in fact benefiting. Now, these balancing acts government will obviously have to make, but on an overall basis, if we look at the PLI scheme, roughly 2 lakh to 3 lakh crores of investment is what one can anticipate because of the PLI scheme over the next 4 to 5 years. Now, to put it in context, the total budget of Indian government on capex in the current year was 7.5 lakh crores, and of that, roughly I'd say about 1.5 to 2 lakh crore is really grants that it will be giving to others to actually that is states as also other grants for them to actually go out and spend. I mean, that is the level of investment opportunity that PLI has created. Now, in a time like this, India has really stood up very well. The Indian real estate cleanup, Indian banking sector cleanup happened over the last 6-7 years. The reforms that were undertaken in the Indian context, having one nation, one same tax for everybody, a reduction in cost of capital by reducing taxes, over a period of time, of course, the interest rate conundrum, where India's interest rates are higher than global rates, that will have to be addressed. But overall, India is in a very sweet spot and ready to take this opportunity over the next 5 years. And our belief is that if there is a market, and this is not, I mean, you can discount what I'm saying, but listen to what John Chambers is saying. If there was one country which one should bet on at this time, it is India. And if there was a second, it would still be India. Which means that this is a country where we are seeing significant opportunity and tailwinds. It has the size to absorb capital, and we believe that the next 5 years, if if everything, I mean, if there is no nuclear war or there is no other pandemic or any of those extraneous factors don't come through, India is a country which will see significant tailwinds over the next few years.
So in a sense that we will continue to attract capital globally as well, and maintain a certain balance in our rupee as well as our reserves, so to weather whatever storm may happen over the next short-term period. So keep that in mind while looking at your investments. But let me now take a little bit of a turn here. We've all spoken, a lot about the opportunities, a lot about the growth that can come. But we must also balance it with a view of what can go wrong. Now, there are a few things that I would like to touch upon here, if the panelists can shed light on. One is, we have been having very anemic job growth, which has impacted consumption. Obviously, the capex cycle has not happened over the last decade, which could, have spurred some of that income growth and, more consumption to come through. But is there anything that we need to be mindful of, considering that we're all coming from a positive mindset of, things look great, but what can go wrong? So Anshul, why don't we just start with you?
Sure, Rakhi. So on jobs, I mean, there are panelists here. There are people sitting and watching this show or this discussion. If you ask all of us, I don't think really in the white-collared space, there has been too much of an impact post-COVID. Really, jobs have been retained. In fact, jobs have been added. And so this space has done quite well. The bottom of the pyramid, that is the construction activity, the daily wager, that's, or even the people working in the unorganized sector, that's where there has been a little bit of a pain. Now, if you look at, again, the policies and how the macro environment has been moving of late, the investment allocation to capex from the government side in the recent budget, as also the real estate activity, tailwinds on real estate that we are witnessing across the country, these bode well for that lower end of the pyramid, because these are the largest job creators in the country for the lower end of the pyramid. In our judgment, these two factors will add to job creation in that segment. We are actually more confident than not that the job situation in that segment should do well. And then if you look at the white-collared segment, I think that there is room to be quite constructive and actually positive on this space, because the kind of activity that India will see in that segment, the larger corporates, more organized sector, the economy becoming more organized, we think that there will be job creation there. And so in that respect, I think that from here, in both the top end of the pyramid as well as the lower end of the pyramid, we have room to be or reason to be confident. As regards what can go wrong, in our judgment, there is two realities to the equity markets. One is valuations or liquidity-led valuation, and the second is growth, earnings growth on the ground. As regards growth, it looks like, for all the reasons that we have discussed, there is room to be reason to be confident. But as regards liquidity and valuations, as inflation moves up globally, the fountainhead of all liquidity, which is the US, will look to raise interest rates, and that will raise risk, the risk metrics for equity markets. And in our judgment, that is one risk that one will have to factor in. And aside from that, sort of black swan risks like a credit event globally, or even an event like the recent pandemic, those are things which we can't really factor in beforehand, but those will be the other risks that one will have to grapple with over a period of time. So I think that credit and liquidity-driven risk is a greater reason for worry for India than actually growth.
Shailendra, would you like to add to that, considering or pinpointing, what sectors one could probably look at to avoid some of this credit and liquidity-led risk that might happen?
Yeah. See, as Anshul said right now, the risk primarily, comes from the kind of liquidity that we can see reducing, changing the market prices, right? As I said also in the beginning, handling some of the question, we are seeing a regime change right now as far as the money market goes. We were living in it more than 10 plus years. We were living in a very, very easy liquidity era. And now we are shifting our gear across the world collectively in form of a more calibrated money market situation now. till now, if I the way I'm looking at things looks very orderly. I mean, this large transition appears to be going on very, very orderly to my mind. But yeah, you never know, because such kind of a major regime switches can impact things way faster at times, and momentum can catch on the downside. But as on today, it looks happening very, very orderly. I mean, the kind of a correction we are seeing in the market across the world, you look at Europe, look at here, a lot of valuation anomaly are getting corrected. They are not giving you a structural derating kind of a scenario, but a adjustment which is happening in a macro market. So I think risk is there. We have to be very, very watchful. But look at in any other in any way, this risk is not something which will turn into a kind of a black swan that we fear all the time. But yeah, you can't write off situation like that, because something is unknowable and unknown right now, right? In terms of sectors where we have to be very, very concerned is like at some of the pockets of the market, you are paying very high premium for either the quality of the businesses or for kind of a growth which is assumed by most of the analysts. When the cost of capital starts going up, your discount rates start going up. If the discount rate for some reason goes very, very high, and your valuation is nothing but earnings divided by discount rate, right? So if the denominator goes very high, which does not look to be the case in India. In fact, my own understanding is India's interest rate been higher than, say, Korea, China, US interest rate for long, long time. But look at the interest rate differential. It is narrowing a lot. Right? It's continuously narrowing. Look at the RBI policy. The guidance looks very, very clear. We will remain higher in terms of rate in India. But the differential, which is the most important thing, the delta between our interest rate and say US or UK or say China interest rate, the delta is narrowing, favoring us in that sense, right? But for some unforeseen reason, suddenly we see a spike in interest rate way higher than the earning growth can handle for valuation to remain where it is. That would be something you have to be very, very, carefully looking at.
Okay, so I'm gonna pin all you guys down, because the session started with growth in business earnings in various sectors, and I think all our attendees would like to really know which sectors that they should focus on over the next 5 years. So Madan, just to lay it in context, I read a recent report by which Goldman Sachs put out saying that the Nifty composition over the next 2-3 years could see a major shift with new age businesses, occupying at least 14-15% of the index, whereas today it's hardly 1 or 2%. So give us, our audience, clues into which sectors should they really focus on over the next 5 years.
Let's start with the sector you mentioned. I think new age, we kept away from this space because the kind of liquidity that was chasing from what veterans have said, the greed, you can really establish that greed that was playing out in the tech companies for the last 6 months or so. I think that space is not yet done. It is likely to see. Some of them benefited from the lockdowns and all this we have seen, right? So a lot of benefit also they got from pricing their products. So all this will come off in the next 1 year. Earnings will go through the tough time. So tech age, we have to be really careful. In our opinion, both valuation, it looks very high. There is very little margin of safety in that space. But from a Nifty composition, last 3 years, if you see, it was supported by metals, which came up really strong, which was lagging behind significantly for the last, say, 10 years or so. So last 3 years, we saw metals coming back, oil and gas coming back, and then the telecom also coming back and supporting what was previously supported by consumption and banking mostly, and in pockets by IT sector as well. I think next 4 or 5 years, we will mostly go back to the same scenario, it looks like. Banking, supported by IT, as well as, say, some of the manufacturing sector, which was probably lagging behind in the previous 5 years. That can give a fill-up to the earnings growth momentum. But I feel metals have seen probably the peak, as it looks like. The further upside, if you are looking in metals, it can come with a very high inflation globally. So that is going to be, say, non-consensus on equity itself. Any high inflation scenario, which there is a possibility for that. The political driven inflation right now playing out globally, hopefully we should see that getting contained. Otherwise, we are likely to see interest rates much higher than the pre-COVID level. So that is not good for growth anywhere, and that can hurt India also. So I think metals as a sector, I hope inflation normalizes in the second half of this year, and from there I think earnings growth could be a little difficult. Oil and gas, again, political inflation globally, how OPEC and others come down, and Russia and Europe meets their eye, and Iran comes to support. All this are playing out globally. But probably this liquidity has driven the metals and the commodity space earnings much more faster than what should have actually happened over the next, say, many years. So there I see the earnings normalizing because these companies benefit when the prices go up a lot when in their earnings swing, not mostly because of the production increasing, because that is only 30-40% flowing to your PAT, right? But when prices go up, the entire thing flows out to the PAT. So that is behind us. So the transition from metals, energy, and all this to earnings support coming from banking, financial services, and then say some of the manufacturing companies. That's the way I am looking at.
Anshul, do you have any different opinion? I mean, you did speak about consumption being a big play. So are we going to see the index with a lot more discretionary businesses filling that gap up?
Definitely. We do believe, Rakhi, that there will be discretionary businesses which will do very well. And you could actually broadly classify into opportunities, in our judgment, in 4 or 5 buckets. Real estate and related sectors, which will, of course, include discretionary spends. We think that real estate is going to see significant tailwinds going forward. We are coming off a 6-7 year period of cleanup. We think that that's going to change. We believe that capital expenditure, private as also public, is on an upswing. We are only at the beginning of that. And once this cycle starts moving, it doesn't end in a one year, 2 year kind of a cycle. It goes on for a period of time. We think that capital goods companies, as also certain infra companies, will benefit as a result. Sugar has been bitter for the longest time. It's going to get sweet. And we think that that is a space for reasons specific to that sector, which will do very well. And over the next few years, we're going to see quite a bit of tailwind in that space. Financials. I mean, if you were a follower of financials, banking in particular, and you were listening to con calls over the last, say, 4-8 quarters, the kind of turn in body language that one is seeing off late has not been witnessed in a long time. And in our judgment, that, of course, it ties in with the expectation that there is going to be capital expenditure in the country. Our judgment is that banking is going to be a big beneficiary of tailwinds in demand. So these are some pockets which one can actually look at if one is looking for opportunity.
Oh, great. So Shailendra, I give you the last remarks benefit. We have basically half a minute left. So any concluding remarks around this topic would be great to kind of sum up what we've all discussed.
So maybe carrying this Nifty composition talk a little forward, see 80% of the Nifty is where? IT, banking, consumers, and healthcare, right? If you take a large economy like US and look at the S&P 500 composition, exactly same, 75% into these 4 baskets. So we are already there, right? But there will be some names which will be coming out and going, away from the Nifty. Some new name will come. See, in Nifty, there are a lot of companies with less than 1 lakh crore market cap, right? At the same time, in the Nifty next 50, you have many companies with more than 1 lakh crore market cap, right? In the Nifty next 50, where the floats are going to go higher from here on, and you have a thesis that the market cap will also move. So those are the opportunity on an individual paired basis, maybe in insurance company, real estate, as Anshul rightly mentioned, couple in the card space. So those will be the name which will be moving around the Nifty in the next 5 years.
Great. So thank you, Madan, Anshul, and Shailendra for the insightful conversation. A lot of points to ponder upon for our audience as well as all of us as investors. I thank the PMS AIF team as well for having all of us here.